Ever wondered how the stock market works or what exactly stocks are? It's a fascinating world full of intrigue and complexity. From the bustling trading floors to the electronic transactions of today, stocks have shaped much of our world's economic landscape. Today, we're unraveling the mysteries of stocks, the stock market, and their impact on the world economy. We'll delve into what stocks are, how the market operates, its history, functions, and influence. Join us as we embark on a journey to understand the dynamics of stocks. So what are stocks? Well, imagine you have a pie. This pie is a company. Each slice of the pie is a piece of the company or a stock. When you buy a stock, you're essentially buying a slice of the company's pie. You become a shareholder and owner of a piece of the company. Now, the size of your slice or the number of stocks you own determines how much of the company you own. The more slices you have, the bigger your ownership stake. Your profit or loss depends on the performance of the company. If the company is doing well, the value of your slice, your stock, increases. Conversely, if the company is not doing well, the value of your stock decreases. Now that we have a basic understanding of stocks, let's delve into how the stock market operates. The stock market can seem like a complex web, but it doesn't have to be. Think of it as a bustling marketplace, a central hub where buyers and sellers converge, but instead of fruits, vegetables, or crafts, they are trading shares of public companies. Now let's break it down. What exactly is a share? Well, a share represents a slice of ownership in a company. When you buy a share, you're essentially buying a piece of that company. The more shares you own, the larger the piece of the pie you hold. But how do you buy or sell these shares? This is where the role of brokers comes into play. Brokers are the middlemen of the stock market. They facilitate transactions between buyers and sellers. When you want to purchase a share, you would place an order with your broker, who then finds a seller and completes the transaction. The same process happens in reverse when you wish to sell your shares. Now, this might make you wonder who sets the price of these shares. Well, it's a dynamic process governed by the laws of supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. But the stock market isn't just about buying and selling shares. It plays a crucial role in the economy. It provides a platform for companies to raise capital by selling shares to the public. This capital can then be used to fund new projects, expand business operations, and create jobs. On the flip side, investors get an opportunity to own a part of the company and potentially earn returns if the company does well. It's a symbiotic relationship that fuels economic growth and prosperity. Now remember that the stock market can be volatile, with prices fluctuating due to various factors from company performance to global events. But armed with knowledge and a bit of patience, you can navigate this labyrinth with confidence. With these fundamentals in place, we can now explore the history of the stock market. The stock market as we know it today has evolved significantly over the years. Its journey is one of innovation, resilience, and adaptation. To fully appreciate its significance, let's voyage back in time to where it all began. Believe it or not, the concept of a stock market dates back to the 12th century, where French courtier de change managed agricultural debts on behalf of banks. But the real game-changer came in the 17th century with the establishment of the Amsterdam Stock Exchange, the world's first formal stock market. Here shares of the Dutch East India Company were bought and sold, pioneering the concept of trading company ownership. As we moved into the 19th century, the New York Stock Exchange emerged as a dominant force. It was during this period that we saw the open outcry system where traders would communicate with shouts and hand signals in a bustling trading pit. It was chaotic, but it worked. Fast forward to the late 20th century, and the advent of electronic trading began to reshape the landscape. The noise and confusion of the trading floor started to give way to the quiet hum of servers. With this shift, trading became faster, more efficient, and accessible to a broader range of participants. And now, in the 21st century, the stock market is a complex global network of interconnected electronic trading platforms. It's a far cry from its humble beginnings, but its core purpose remains the same: to facilitate the buying and selling of company shares. Understanding its functions will give us a clearer picture of its role in our economy. The stock market serves multiple functions that are integral to our economy. Let's delve into these functions to get a better understanding. Our first stop is capital formation. When a company issues shares to raise funds, it's a way of forming capital. This capital can then be used to expand the business, invest in new projects, or pay off debt. Essentially, it's a way for companies to fuel their growth without taking on additional debt. Next, we have to provide liquidity. The stock market acts as a platform where buyers and sellers can easily trade stocks. This ease of trading means that stocks are liquid assets. You can quickly turn your shares into cash if you need to. This liquidity is what makes investing in stocks attractive to many investors. Lastly, we look at valuation. The stock market plays a crucial role in determining the value of a company. The price of a company's stock is a reflection of what investors believe the company is worth. If a company's stock price goes up, it suggests that investors believe in the company's potential for growth and success. These functions of the stock market, capital formation, providing liquidity, and valuation, are like cogs in the machinery of our economy. They keep the wheels of commerce turning, helping businesses grow, and investors make informed decisions. The health of the stock market often reflects the health of the economy. This statement might seem like a bold claim, but don't rush to dismiss it just yet. To understand how stock prices mirror economic health, we need to delve into the intricate relationship between the two economies and complex systems that involve countless transactions between individuals, businesses, and governments in this mix. Companies are significant players. Their health, profitability, and growth prospects are directly tied to the broader economy. When companies do well, they can hire more employees, invest in new projects, and contribute to economic growth. Positive performance is often reflected in their stock prices. On the flip side, when the economy falters, companies typically face reduced demand for their products and services. This can lead to lower profits, layoffs, and a contraction of investment. In these negative developments, it can drive down stock prices. In essence, the stock market is like a barometer for the economy. When stock prices rise, it usually signals that businesses are thriving and the economy is healthy. Prices can indicate economic trouble on the horizon, but it's essential to remember that the stock market is not always a perfect predictor of economic health. Occasionally, it can overreact to short-term events or underreact to long-term trends, making it a useful indicator but not the only one to consider. Not only does the stock market impact the local economy, but it also has a global influence. The U.S. stock market doesn't operate in isolation, and this line couldn't be more accurate, especially in today's interconnected world. The U.S. stock market plays a pivotal role in global economics, influencing various sectors and economies worldwide. Consider this: when the U.S. stock market sneezes, the rest of the world often catches a cold, illustrating its significant influence on the global financial health. Major market fluctuations in the U.S. can trigger a ripple effect across the globe, affecting everything from the value of currencies to the price of commodities. Moreover, the U.S. stock market serves as a barometer for global economic health. Investors worldwide closely monitor market trends and economic indicators from the U.S., using these insights to inform their investment strategies. So, whether we like it or not, the U.S. stock market's influence extends well beyond its borders, shaping the global economic landscape. As we can see, the dynamics of stocks in the stock market are indeed fascinating and complex. We've taken quite a journey, from understanding the concept of stocks to delving into the intricate workings of the stock market and traveling back in time to its historical roots. We've uncovered the pivotal functions of the market, recognized its influence on our economy, and acknowledged its global impact. This exploration of stocks in the stock market is just the tip of the financial iceberg.